like to say, first of all, hello to everybody who is attending this conference virtually. Obviously, would have been great if I could have been there in person, but the beauty of technology is that we are going to still proceed. And just want to let everybody know that I will be fielding questions in real time during this presentation. So if you have anything you want to run by me, please feel free to do so. My name is Paul Davis. I'm the Director of Market Intelligence at Strategic Resource Management, a consulting and advisory firm based in Memphis, Tennessee. We specialize in things like payments and core provider contracts, but we also handle things, areas such as management consulting, as well as a crypto consulting practice that we just opened up a few weeks ago. Today's presentation is going to be on the state of fintech, looking at the threats and opportunities that banks face from financial technology companies and other industry disruptors. Let's start with the basics. What is a fintech? I believe if you talk to 10 people, you would get 10 different definitions for a fintech. So for the purposes of today's presentation, we'll keep it relatively simple. For today, we're going to consider a fintech to be any type of technology that is used to improve the delivery of financial services. The question comes up, obviously, is PayPal a fintech? Is Amazon a fintech? Is Square a fintech? Well, the way I look at it is there are going to be some companies that are broad-based and financial technology is one tool that they use for their business model. And then there are some that are really directly focused on the financial sector. So that's kind of how I look at it. I mean, there are going to be tech companies that delve into financial services. There are going to be financial services companies that are tech oriented. So we're going to look real quickly at the history of fintech, going back to the 20th century and working our way to today. And you'll see that as we've gotten into the most recent years, it's really become a much more consumer-oriented industry, trying to make products that are more streamlined, more targeted, and removing friction points and pain points for the consumer. This is just a nice timeline that shows kind of how we've progressed through the last 100 years or so. If you look at it, the early progress in the technology space was much more obvious and much more visual, whether it was in the card space, whether it was the ATM. And as you see, as we've gotten into the 1990s to today, you start looking at things that are much more software-based, much more cloud-based. You get into crypto, you get into digital wallets, online banking, mobile payments, and those kind of progressions have accelerated as we've gotten closer and closer to modern times. And obviously, a lot of that is tied to consumer preferences. Much of those have been shaped dramatically over the last 2 years, I should say, because of the pandemic. As fintechs have become more popular and more integrated into the financial system, you can also see how venture capital funding for the industry has increased as well. There was clearly a lull during the early stages of the pandemic, but that is well behind us. If you look, VC funding globally has been increasing steadily for the last few quarters. And in the third quarter, that $31.1 billion is a high, record high for fintechs globally. So at SRM, we look at fintechs, we put fintechs into 3 general buckets. I mean, again, the idea is this may be an oversimplification, but I think it does help, conceptualize a topic that sometimes is kind of hard to wrap your head around. So for our purposes, we look at 3 types. You have complementers, which are going to be fintechs that can help a traditional provider, a bank, a credit union, continue to compete. And we're talking about process improvements, new products, new services, filling gaps. We're talking about speedier decision-making. We're talking about easier interfaces for consumers. basically things that help financial institutions improve the depth and quality of their product lines. Then of course, you have competitors. I think about that generally in terms of challenger banks, neobanks, and other companies that are looking to directly compete with the financial services industry, with mainstream financial services, whether that's on the lending side, whether that's in terms of products like wealth management, insurance, things like that. So that's where you're going to see some of the battle lines drawn now and in the future. The third group would be catalysts. These are the kind of fintech companies that we would consider are shaping and reshaping the conversation. This is going to be in areas, I think, such as redefining what it means to be a community. I will touch on it later, but historically, communities have been defined by neighborhoods, zip codes, towns, and cities. Obviously, with the rise of neobanks and really niche banking, we're seeing that community reshaped into affinity groups and other demographics through data analytics and segmentation. So a lot of discussion in the banking industry has been whether there should be whether we should be figuring out ways to kind of keep fintech from entering into the mainstream. The Conference of State Bank Supervisors, CSBS, had filed a lawsuit a while back when Figure Technologies had applied for a specialized OCC charter that would have allowed them to operate without FDIC insured deposits. CSBS recently dropped that lawsuit when Figure decided not to pursue that specific type of strategy. Still, the debate continues about whether the OCC should offer a fintech charter, should issue those types of charters. I would make the argument that the horse is already out of the barn, and there are many examples of fintech companies that have already gotten dipped their toes into mainstream banking. So for example, Square and Vero have received FDIC approval already for deposit insurance. And Vero Bank debuted in 2020, and Square, their industrial charter bank, opened just last year. Acquisitions are another thing to look at. Green Dot, Lending Club have already bought banks to obtain charters. And last night, the OCC gave conditional approval for SoFi to buy Golden Pacific Bank. And the Federal Reserve has already approved their application to become a bank holding company. Now, the interesting thing I will note about that is in the OCC's approval, SoFi has been barred, at least for now, from offering crypto-related services. So I thought that was an interesting thing. It's worth noting that the OCC is putting certain conditions on fintechs that are looking to buy and banks and get into mainstream financial services. Speaking about the OCC, also, if you look at it, there are crypto firms out there that have gotten conditional national trust charters. Then you also have, we'll talk later about banking as a service. And so you've seen folks, banks, financial companies like Daylight, Nerve, Purple, enter the banking system by partnering with banks that already have charters and regulatory approved infrastructures. And then finally, back to Figure Technologies. While they may not be pursuing this particular strategy with the OCC, they are working with banks such as New York Community Bank and National Bank Holdings in Denver to develop blockchain projects. And in fact, they're all involved with a new fund that's going to be built around investing in blockchain endeavors. This is an extremely busy chart by design. The point here is when you look at the fintech ecosystem, it's broad-based, it covers many different industries within financial services. I mean, if you look at it, you've got everything from credit scoring, you've got wealth management, you've got digital banking, you've got payments. And in each bucket, there's a large number of fintechs that are operating in that space. Now, as a bank, that might be advantageous because these are the types of guys that you might want to partner with And given the competitive nature of each bucket, there might be some opportunities there when you're actually evaluating and negotiating those third-party relationships. Okay, so when I present, I try to, again, make this as simple as possible to understand. From our perspective, there are three ways that banks can work with the fintech space. And at each level, you're basically trading off a little bit more risk for a little bit more return. So let's start with the basic premise here: partnerships and contracts. Basically, this is a situation where you would work with an outside vendor, fintech, to add a product or service that you're lacking, to streamline a process, or come up with other ways to improve the interface with customers, remove friction points, etc. We'll talk about a few examples, but obviously banking as a service is an extremely popular option and a route that banks are taking right now to provide services to aspiring challenger banks and neobanks. Once you get through that process, the next step would be to make a minority investment. We'll go into some examples here later in the presentation, but this could be either in the form of direct investment in a minority stake in a fintech. There are also examples of banks pooling their investments into funds, and those funds are being used to invest in fintechs as well. There are some advantages here. So number one, an investment might be able to help you get a little more insight and clarity into the fintech's business strategy, in its financial projections, and just where that business enterprise is looking to go. In some instances, when you negotiate a minority investment, sometimes board representation is on the table. That would also provide you with some ability to shape the direction of your fintech partner. Obviously, there are risks involved. If a fintech investment goes sour, you're on the hook for that. That's why it's very important to evaluate those opportunities before you actually take advantage of them. Then the third step, the most involved step, is an outright acquisition. We've seen a number of those, not many, but enough to note in the last couple of years, where generally speaking, larger banks, regional banks, are buying fintechs to fill, again, gaps in their product line, or they're using acquisitions as a way to add earning assets in a challenging growth environment. Recent example, Fifth Third recently bought Provide. That's a fintech that's focused on healthcare professionals. Fifth Third has had a relationship with Provide for several years, where they've taken on Provide loans, put them on their own balance sheet. But with this deal, they'll take loans that Provide would otherwise originate and sell to other financial firms, and Fifth Third plans to keep most, if not all, of those loans on its own balance sheet. Again, when you talk about risk and reward, there is the potential for revenue growth because you're taking advantage of holding loans on the balance sheet, deriving income from that. The flip side is obviously, again, the risk, and we'll talk about the rewards and the risks here in a bit. All right, so here are some recent examples over the last year or so. I won't go over all of them. I'll just highlight a few as we go through this presentation. I mentioned earlier that there's a blockchain investment fund. That really is kind of a second stage kind of situation, because a year ago, 70 banks invested $150 million in a bank tech fund. That fund is investing, I believe it has a couple of investments under its belt currently. If you guys want more details on that, obviously feel free to comment or ask questions. I believe I can find that in the next, as we go through the program. I mentioned before, National Bank, as well as New York Community, they're working with Figure Technologies. Those relationships also included an investment in Figure. Let's see, what else can we talk about? MVB Financial in West Virginia. That's an interesting example. They're building their own fintech ecosystem. So they have a number of fintech clients, but they have also, through acquisition, built a portfolio of service industry, service companies. So they've bought into the consulting side of things. They can handle some legal aspects. They also recently worked out a deal with NYDIG where their fintech customers can now deal in Bitcoin. So MVB is an interesting company to look at if you want to look at the idea of building your own internal network for fintech. And then when I talked about the larger acquisition, larger banks buying fintechs, Connect One is a much smaller bank, but they bought BoeFly, an online loan exchange, a few years ago. And the interesting thing about BoeFly is when the Paycheck Protection Program came out 2 years ago, not only did Connect One deal in PPP, but BoeFly as a loan exchange also had a role with the program that brought in more revenue for Connect One. So let's talk about banking as a service. In a nutshell, fintechs want to bank customers, but they lack a charter. Most of them lack a charter, and they also lack the infrastructure that's been signed off on by the federal regulators. So what do? Well, they partner with existing banks that have the charter and have the regulatory infrastructure in place. Some examples, as I mentioned before, you have Daylight, which focuses on the LGBTQ community. You have Nerve, a musician focus group. They're working with Piermont. That's a de novo out of New York. And if you really want to get into a niche, Purple, which is working with the Bancorp, they focus on disabled customers that rely on government assistance. So you're seeing a lot of banks get into banking as a service. I believe Central Pacific and Hawaii will soon be providing more details about their product line as part of their earnings release in the next week or so. But what we're also seeing is several banks starting to layer added services on top of that banking as a service platform. Piermont, as I mentioned before, started out with backing folks like Nerve. Now they've created a division called BankFi. Their idea is that they will replace equity investment with more traditional credit products, providing a lower cost of capital for their fintech customers. Main Street Bank in Virginia has created a division called Avenue. This is a national platform that's going to, in theory, help fintechs accept deposits and process payments. So again, what you're seeing now is kind of a second stage of this platform, right? You have banking as a service, where you're providing the behind the scenes infrastructure. And now a lot of these guys are trying to layer on products and services that will boost revenue over time. Another example of banks getting more and more into the fintech space is the buy now, pay later trend. It's really not a new concept. I mean, a lot of people, basically say it's essentially a layaway program that's been boosted by technology, making it more seamless, making it more accessible, making it easier for people to purchase goods and then set up their payments over time. It was really spearheaded by the fintech industry. If you look at PayPal, Affirm, Afterpay, et cetera, those guys really pioneered it. And in a related situation, point of sale lending is another big thing that's been spearheaded by a lot of fintech companies, and banks are starting to get into it as well. We're watching Apple Pay, obviously, to see what they're able to do with buy now, pay later. I'm kind of, if you look at it, their share is not growing by leaps and bounds, but it is growing. So it's something to pay attention to. Talking about investment and acquisition, you can also see here that there are several examples. Truist is buying Service Finance, a point of sale lender. Goldman Sachs is buying Green Sky. Discover made a big investment in a platform called Sezzle, and Square is buying Afterpay. Let's talk a little bit about M&A and purchase agreements. The reason I wanted to highlight this is because there are banks out there that are looking to add earning assets to their balance sheets, as we discussed earlier with Fifth Third and Provide. And one way to do that is to buy a company that historically originates and sells their production, and instead hold those loans on the balance sheet. So in addition to Fifth Third and Truist, Regions Bank bought Interbank. Now it's an industrial loan company, but it's also focuses on home improvement projects. So again, Regions is going to, you try to use that, expand it, cross-sell it, et cetera. And then purchase agreements. We haven't seen a lot of those, but First Internet has one with Apple Pie Capital. Apple Pie focuses on lending to franchisees. And as part of that arrangement, First Internet is going to be buying millions of dollars of loans from Apple Pie Capital to theoretically hold on its own balance sheet as well. I'm going to take a quick pause right now so those of you guys who are watching this can get caught up, and I'm going to take a quick look and see what kind of questions we have. I'll respond to those obviously over the remainder of the presentation. So take 1 second and then let me get caught up. All right, so I'll continue to answer questions obviously as I go through the rest of this this program. There are other ways to work with fintech. I've been watching and listening to presentations from my peers recently, and this was basically my attempt to take all the information that I've gleaned from other sources over time and just kind of distill it into a single slide. So bear with me. But if you look at it, referrals are one way to work with fintech, whether that's a situation where maybe you have a borrower that doesn't qualify based on your underwriting standards, and you're able to refer that person to a fintech that can handle that loan. You can also receive leads and accounts from the fintech as well. So there can be a symbiotic kind of relationship there. We've discussed investment and M&A. We can talk a little bit about private label. That might be a situation where your bank is buying the technology from a fintech in order to improve the quality of service for your customer base. Outsourcing is always a possibility. I think that's not unlike other vendor relationships. And then you've got, of course, the true partnership there. And a true partnership can either be really a front end kind of situation where it's something that the customer can see and experience. It could also be back end work, kind of the things that are behind the curtain that still create a seamless experience, but maybe isn't as obvious to the end user, your customers. So you want to explore fintech. You're curious about it. You want to make something happen. How do you go about doing it? Well, there are several things I think you should keep in mind as you're putting together your fintech strategy. Number one, figure out what the end goal is going to be. What kind of bank do you want to be? What types of customers do you want to serve? And what kind of products, services, and processes do you need to get from your starting point to the finish line? Again, I think with a lot of strategies, it's always good to kind of look at the end game and then work your way back to today and figure out how to get to where you want to go. So craft that strategy, decide early on what that strategy looks like, and then figure out whether the best way to accomplish that is through investments, partnerships, or acquisitions. I recommend that you create an innovation committee within your bank to drive that creativity and encourage people from various backgrounds to weigh in on the strategic direction. I think buy-in should include someone with financial acumen, someone with legal expertise, client-facing employees, someone to represent the client-facing side of things. Basically, it's not just your tech folks. I think this innovation committee should have feedback from anybody who, has to face the customer or look at the financial and legal implications of a strategy. I'm also a big advocate of conducting a SWOT analysis. Look at the strengths and weaknesses of your existing capabilities, but also the opportunities and threats presented by challenger banks, neobanks, et cetera. So a position map is not a bad thing to look at as well. How do you stack up strategically versus your peers, versus, new entrants into your market? And just get a sense of where you need to improve. What are you good at and where do you need to improve? Be open to opportunities. Now, I'm not saying dive into the pool. Clearly, the goal is to minimize the risk. However, once you have that strategy in place, that enables you to be receptive and open when a new technology comes out, a new product comes out. You don't have to be an early adopter, but you should still be in a position to take advantage of an opportunity rather expeditiously when those opportunities arise. Across the bank, instill a culture of change and innovation. Encourage your employees, from the frontline folks to your C-suite, to always be thinking of ways to innovate, to improve, to make your bank better. And be comfortable with failure. Not every idea is going to be a success. Not every strategy is going to be a home run. And embrace shortcomings as a way to learn a lesson and improve going forward. And then, of course, another question is, is this going to be a passive or more active approach? Are you looking at, again, that idea of an interface that the customers are going to recognize and see? Are you looking at things that are going to be a little bit more behind the scenes? So really get a sense of that balance too, about how much of your innovation is really going to be noticed by your clients, and how much of it is really going to be that idea of you're making things better for them, and they maybe aren't even consciously aware that you're making things better. As I mentioned earlier, every strategy provides an exchange of opportunities and risks. And as I mentioned earlier, there's a layer of opportunity and risk with a collaboration, increases with an investment, increases more with an outright acquisition. Let's look at the opportunities first. Let's keep it positive to start us out. A fintech strategy can help you expand your reach to new clients through digital channels. We've seen some banks that are able to take and go from their local market to offering up a national platform because of digital channels. So that's one possibility. We've discussed earlier the idea of redefining your community. Data analytics and segmentation can take you from being the neighborhood bank to being the bank for, you name it, whether it's a demographic group, whether it's a professional group, whether it's Gen Z. The idea is, if you realize that there's some kind of compatibility between your strategy and a particular demographic group, fintech can help you decide if that's worth pursuing and then help you actually achieve your goals. There's also a long-term opportunity to reduce overhead, particularly for banks out there that maybe have larger branch networks and could pare those back. I mean, we've seen a number of banks of various sizes relying more, reducing their branch networks by 10 to 15%, and then channeling those savings into enhanced digital offerings. Certainly the pandemic has accelerated that over the last couple of years, and that digital shift is only going to continue. We're never going to go back clearly to where we were before the pandemic. And then, of course, a happy customer is, in theory, a loyal customer. So you're going to want the customer experience to be frictionless. You're going to want faster decisioning. the longer it takes to make a decision, the more likely your customer is going to look elsewhere for that loan or for that secondary product. So again, fintech, if done properly, can make faster decisions responsibly and make the customer experience better. Let's talk about the risks, because clearly there's always a trade-off. Break it down into 3 simple risks. Number 1, reputational risk. If you look at the fintech space, we've seen what happened with Robinhood and some of the fines that they had pay. Chime has had some issues with closing accounts without notifying customers. At least that was in the headlines. We just did a brand loyalty survey at SRM actually a few months ago, and Chime did have a pretty low score as far as their customer satisfaction. So think about that. And then also, when you look at the Paycheck Protection Program, there were studies that showed that there were higher cases of fraud with fintech originated loans as opposed to those that the banking industry originated. So again, the key here is you want to avoid, if possible, those kinds of headlines and those kinds of situations. Credit risk, of course, especially if you're doing when you're buying a fintech or taking fintech loans and putting them on your own balance sheet, there's obviously a potential for credit risk. My advice there is, when you're vetting that fintech relationship, take a look at their underwriting, ask the tough questions, and see if that fintech's strategy and their standards, the closer their standards are in alignment with your own, the better chance you have of managing the credit risk in that relationship. So keep that in mind. And then finally, financial. Obviously, if you invest in a fintech and something goes wrong, that's a financial hit. If you buy a fintech and something goes wrong, that's a bigger financial hit. So again, when you're looking at this, those are some of the questions that you'll need to ask yourself. And what do you know? The Fed, the FDIC, and the OCC have also done some of that thinking for us as well. They put out their 6 pillars of guidance for working with fintech. They said that they were not going to necessarily enforce these guidelines. It's my opinion, however, that if you have a fintech relationship that goes sideways, I wouldn't be surprised if you are asked by your examiner at some point to show that you followed this instruction. And honestly, most of this to me looks relatively intuitive, but it all makes sense. So when you're looking at a fintech partnership, you should look at how much experience that fintech has, look at their financial shape. Are they complying with federal and state laws and regulations? How do they handle risk? What are their underwriting standards, et cetera? How well can they secure your information as well as your client's information? And are they operationally resilient? Are they going to be around 5 years from now, 10 years from now? Especially if you're looking at the idea of potentially acquiring somebody over time, you want to make sure that they have a business plan that ensures some longevity. In addition to my advice on how you pursue a strategy, I am a huge advocate of building your own ecosystem that involves not only internal participants, but people outside the bank as well. We'll go over some of these. I didn't put employees on there, but I should stress right up front that having your employees on board and informed is an important part of the strategy. I think a large part of your pushback could be from your employee base, simply because they're the ones that are going to deal with the upset customers if a strategy goes wrong. And so they're going to be a little bit wary. I would just assure them that the strategy is necessary. The strategy will keep you competitive, and the strategy will make things easier over time. I also tell people to consider having regular updates with your employee base, whether it's a quarterly or twice a year, just kind of overview of where your strategy is headed and what the next steps are. The board of directors is another important resource, because in theory, your board is representative of your customer base. It should be, at least. And so these are the folks that can help you understand where the gaps, the service gaps are, where the pain points are. And I'm an advocate of making sure your board is aware of what the strategy is, next steps, et cetera, because again, that's an important part of corporate governance. And you also don't want your directors to be caught flat-footed if something does go wrong. Just keep them in the loop as you make your fintech journey. Customers, again, customers are a great way to learn what the areas in which you're lacking. I also figure, one thing I think about is if you're looking at a fintech strategy, a pilot program with a sample size of customers is a way to learn without having a potentially widespread issue if something goes awry as well. Regulators, that's another important facet to this ecosystem. They've put out the guidance. They want engagement. And I think the more you engage with the regulators and you're open and transparent about the strategy, the better that relationship can be. Also, several agencies have started innovation groups internally. That should also provide some expertise for you as you're pursuing your objectives. Other bankers. I mean, I find that especially in the community banking space, if you guys are not like fighting for a particular loan or a particular business account, you guys are pretty collegial. And if you're looking at a fintech, ask that fintech if they can discuss, who else they work with and get referrals. Talk to your bankers about it. Hey, have you heard about XYZ fintech? Okay, if you work with them, what's the customer experience? Is there anything you would do differently? Did they meet deadlines? Did they actually put their money where their mouth is? Did they, meet expectations? Have those questions ready to go. Talk to your federal and your state banking associations as well, as far as, a fintech partner is concerned. And I should also emphasize that there are outside folks that can be of assistance as well. Folks like us, at SRM who have experience working with outside providers who can maybe help you come up with a framework and an idea of what questions to ask, what risks to look for, those types of things. Outside assistance from advisors and consultants is an important way to sidestep potential issues over time. Now, let's go back and just, I'm going to give you guys a few more minutes, and then I'll share a few other thoughts as well about some of the other areas that are really coming up. I didn't make some slides on this, but obviously because of our crypto practice, I will give a quick overview of that as well. But let me take a minute and let everybody get caught up, and I'll look at the questions and go from there. Okay, so one last area that I would like to go over briefly is cryptocurrency. At SRM, we recently created a crypto consulting practice. What we're doing now is helping banks and credit unions evaluate crypto strategies to provide services to customers, whether it's consumer or business customers, and evaluate potential partners when it comes to crypto. An interesting statistic right now is that 20%, about a fifth of people out there with investable assets have money in the crypto space right now. And a large percentage of those people would prefer that their financial institution as a trusted advisor kind of manage those assets and help them with that. So there's a huge opportunity. There are a lot of banks out there that are creating very sophisticated crypto practices. I mentioned that MVB is working with NYDIG to help their fintech customers deal in Bitcoin. Take a look at Vast Bank as well out west. They, if you go to their website, crypto is front and center as well for them. So that's another area that is worth watching. we tell people that if you're looking at crypto, you've got to be in it for the long term. It's not a dip your toes kind of pursuit. We also make sure that people realize that crypto should be a scalable product. Be aware that it's not just about Bitcoin. It's going to be about offering your customer base a variety of products and services and access to various types of cryptocurrency as well. To mention this as well, we also offer webinars that go into more depth. So one of my colleague, Larry Pruss, for example, talks about everything from stable coins to decentralized finance, as well as the idea about central bank digital currencies. I can tell you that the idea about crypto and blockchain can be a bit of a head-spinning endeavor, but I do think, and SRM believes, that this is not just a passing trend, it is something to keep in mind. And we're seeing a lot of banks and credit unions lose deposits to crypto exchanges. For example, I was at a panel a few months ago, and an executive basically said to the audience that he was looking and they're starting to lose several $100,000 of deposits just coming out of customers' accounts and going to crypto exchanges. So number one, it would be a great way to maintain liquidity within your institution. And there are ways to derive revenue from doing that as well. So again, I'm happy to take questions on that as well. I'm also happy to, if anybody's interested in discussing that, happy to refer people to my colleagues who are living, breathing, sleeping, eating crypto on a regular basis as well. But I needed to make sure that I brought up crypto just because that is something that I know people are going to ask on this presentation. So I wanted to make sure that I addressed it as well. So with that in mind, I'm going to wrap up. Again, I'm thankful for the opportunity to speak today. And for those who are in need of accreditation, remember that those codes that you need to use are going to be resource and integrate. And I'll repeat that. Those codes are resource and integrate. And again, you see my information here below, pdavis@srmcorp.com, my phone number. If you're more of a social media kind of person, there's my LinkedIn profile. Please feel free. If you have questions, comments, you want to just talk about anything related to fintech or banking in general, please let me know. I'm happy to assist you as well. So thank you again and enjoy the rest of the conference.